Happy New Year, Scott.
So there's a lot of talk about going overseas relative to the U.S. because the dollar is finally weakening from its incredible strength. It's why Gundlach likes that trade. We've talked about that with him often. I want you to listen to what he said on his webcast, and we can talk on the other side. Here's Gundlach.
I tremendously favor non-U.S. equities, U.S. equities at the roundtable prime. I recommend zero U.S. equities and instead more like European, but especially emerging market equities. The emerging market currency index is now above its 200-day moving average. Not by enough to make a definitive statement about it, but if we spend some time here above the 200-day moving average, it's a massive tailwind for the relative performance of emerging markets versus developed markets.
What do you think? Do you agree?
I think that's right. I think one of the tailwinds is certainly the pivot that we've seen with respect to dollar strength. Dollar weakening will support emerging markets. That's been definitely a significant headwind to the EM trade. But I think even the bigger argument for buying emerging markets, and specifically buying China, is the China reopening story. And we've started to see this play out over the last couple of months. But I think we're in really early innings of this trade. Just to put it in perspective, in the third quarter of 2022, there were 2 million outbound travelers out of China, to other countries. That contrasts to about 46 million in the third quarter of 2019. So basically negligible travel last year versus, where you typically have very healthy outbound tourism. That's going to be a significant driver as we start to see China reopening to global, equities, particularly in emerging markets. And so I think that the China reopening story is still in very early innings of playing out. And we're likely to see this really percolate and drive investment performance in 2023.
We had a guest yesterday, in fact, here next to me who likes LVMH for the very reasons that you suggest. The economy reopening, people traveling more and buying luxury goods. Is that on your radar, too?
It is. And I think there's three main areas that you want to focus on for China reopening. Keep in mind that the China reopening story is not going to be like what we've seen in the past, where China rebounds driven largely by commodity-driven strength. This is going to be about people getting back out in the world, spending on consumption, spending on services. And so where I think you really want to focus on is first the travel and transportation industry, specifically focused on China. So that's, the gaming sector, the airlines, as well as, focused on hotels. Second, I think, is that luxury good market. China historically has been a significant driver of the luxury good market, and particularly out of Europe. And I think that as you start to see more outbound travel, as you start to see them, going back to Hong Kong, as you start to see more consumption dollars spent as people are able to get back out in the world, I think you're going to see luxury do really well on the back of that. And then thirdly, I actually think that tech sector could also start to do better as well, and specifically semiconductors, which have, come under significant pressure over the last, year or so. And I think that, as we start to see the China reopen, I think the tech sector, just because, from a usage perspective, but also from a supply constraint perspective, I think that sector could also bounce back.
How do you, if you move out of emerging markets to more developed markets, I still see notes coming out that say to be overweight tactically Europe versus the U.S. as well, because multiples are severely depressed.
And I think actually Europe is one of the biggest beneficiaries of China reopening. They're leveraged much more to the China story than that of the U.S., which is much more domestically driven. And so as you start to see China reopen, that is going to benefit Europe. The other thing that's really benefiting Europe right now is lower energy and natural gas prices. And that is also a big tailwind to the European story, which, came under significant pressure of sort of a move away from, industrial use in Europe and into sort of more competitive markets. And so as you see energy costs abate, that will help Europe outperform too. So I think that, in conjunction with China, does argue for being long developed markets outside of the U.S. relative to the U.S. this year.
It's good seeing you, Erin. We'll talk to you soon. Got to leave it there. That's Erin Browne.